Well, we're going to get into it. I, don't have a s- specific presentation necessarily for everything we're going to cover tonight, but I was going to pull a few things from this presentation. But really, the goal of this little session here, and obviously we'll be recording this, so if you're watching the recording, please let us know if there's any questions or things that we talk about tonight that you'd like to dive into further. The goal of these sessions we always do is to share, kind of some things that I think might be hard to discover on your own. Launching WealthShare and building this company over the last few years, I've learned a lot about the passive investment space, about the raising capital side, and things I definitely wouldn't know if I kind of hadn't been down this path of WealthShare. So that's what I wanted to talk about this evening. So what is passive investments, the different types of passive investments, and I think some things you really need to know kind of before you get started. So that's what we're gonna talk about. Before we get into it, I want to show our disclaimer. So anything we do discuss here this evening is for informational purposes only, and not to be considered as a solicitation for investment, as well as, I don't know if we'll talk about that tonight, but sometimes there's some forward-looking information. We all wish we had the actual crystal ball to predict the future, but we do our best to talk about what we think will be coming. So that's important to understand in these types of presentations that we do. So we'll get into it here. My name is Natasha Phipps. I'm the CEO of WealthShare, co-founder, and also a trustee of WealthShare. I have my two partners here on the screen. They're not here this evening, but Rodney might be popping in at some point, of our co-founder team and operational team here. So Rodney is on the operations side, and Monique is our finance guru, our CFO. So we're all here supporting WealthShare every single day, and have really this common goal and common vision of what WealthShare is to be. And before we get into that, just as a reminder, one of the largest value propositions of WealthShare is our value of accessibility. We want this information to be accessible. We want opportunity to be accessible. There is already plenty of opportunities for the super wealthy people in this country, and the goal is to bring some of that knowledge and make it more accessible. And that even is not just about the information, but even access to opportunities. I know when we started WealthShare out in the marketplace, there really wasn't any offerings that I could find that were similar to ours that had minimums under $50,000. They were all very high. And so our goal is to remove the barriers, not just for the actual opportunity, but also to information. So let's discuss a little bit about what does passive investing mean. And there's a few things I think that people jump to, and that's what they think of when they think of passive investing. So really there's many different types of passive investment, but usually what attracts people to these types of investments are a limit of time or skill or resources, or just plain don't want to do the work that a certain opportunity might take. And so there's ways you can invest passively in all kinds of things out in the world. Real estate is just one of them. And we're obviously going to focus more on real estate tonight, but you can invest in really anything. Our exempt market dealer, Atlas One, even on their platform, I mean, you can invest in music royalties, in storage, in retail. There's all kinds of different things that you can invest in. So that's pretty cool. It allows you to diversify into different industries, different products without doing the work. So some key concepts here to diversify different types of opportunities. There are other ones, but the two largest things you're going to find out in this space, in terms of structures, let's say, is in the private securities space and in the private lending space. And in recent years, the private lending space has become it kind of became a bit of a fad there. Going back 5 years ago, it was using other people's money, or OPM, that became the kind of trending word. And private lending, specifically unsecured private lending, became like it just spread like wildfire, and everyone was using it. And unfortunately, there's been a lot of kind of crashing and burning as a result of that, because The private security world is very different than the private lending world. So if you and I just want to do a private lend together, it's you and me discussing typically. Oftentimes, people aren't even honestly bringing in lawyers or third parties to review paperwork. It's like one-on-one often. And these deals can be, not regulated by governing bodies or securities commission, and I think that is where, unfortunately, a lot of people ran into some trouble. So we do want to differentiate in the private securities world, also in private lending. The Securities Commission legislation applies. It doesn't matter if you're in Alberta or Ontario or whatnot. The Securities Commission rules and legislation does apply. Unfortunately, in the private lending space, especially peer-to-peer, there just isn't the oversight occurring because there is not filing with the Securities Commission happening regularly, as an example. There is not independent financial audits happening every single year. So there's two main differences when we're talking about these space, and the private securities space, though it's not like a publicly traded stock, is still definitely a lot more regulated than what we would see in the peer-to-peer private lending space. Now, I don't want to just wipe everything with, one brush, because the private lending world, there is some good ways to get your money to work private lending. Things like private mortgages are a great way to use assets to secure your hard-earned money against an asset. And that has been, long been used as a popular way to private lend your money and give you security. And you have a mortgage that's built out by a lawyer and secured against a piece of property. So that's one way to do private lending with security, is things like private mortgages. And sometimes you'll see, projects have several private mortgages on them, depending how much equity is in that property. So one tip is, if you do a private mortgage, you want to make sure that the asset that you are securing your mortgage against obviously has the equity or value to carry your debt should something go wrong, right? Because that piece of real estate will become your go-to to hopefully get your capital back. So that's why the security is so important. So any questions on that, let me know. The other thing that I am going to dive into is a little bit more, is a term called suitability. And I think as we're talking more and more about passive investing, I honestly, I don't hear this word enough. I do a lot of speaking, I do a lot of events, and I wish I heard this term more, because it should be top of mind for every single one of us, for an investor, for a capital raiser, because suitability is really the definition that the Canadian government, the regulators have defined as what might be suitable for a particular individual, and it's honestly what we are required to abide by in terms of the amount of money someone should be investing into certain types of investments. So when you invest with WealthShare, or you look at investing with WealthShare, you actually meet with one of our exempt market dealers at Atlas One, and their job is to ensure suitability for the investor. And that is really there to protect you as the investor. Their job is also to make sure that we are compliant, or whoever they are working with is compliant with things like their regular updates, their filings, and paperwork is all in place as it should be. So they're there for very good reason for both parties. But one big message, obviously we're focused on real estate passive investing, so this doesn't apply to other types of passive investments. But in the real estate space, if you are investing passively or actively or whatever, the largest reason real estate makes money or is a lucrative investment and is so utilized by particularly high net worth individuals is because of the asset. It's because of the hard asset. And when you start thinking about passive investments, and unfortunately some of the bad news stories we have seen in recent years, all of those scenarios, not all of them, most of them, there was no security involved. So there was no real estate to actually fall back on. And so if you're doing passive investing in real estate, That should be the number one question you are thinking about. So with WealthShare, we always really like to shine a light that our investors are the 100% beneficial owners of our portfolio. It's not me, it's not Rodney, it's not Monique, and that's not the same everywhere. It's often quite different. And so understanding what you're investing in passively, where is the security? How does it form? And then also that security, how much debt does that security have? So for our portfolio, we have an under 70% loan to value in terms of debt. So it's about 67% or so. I think it's a little bit less, but loan to value in terms of debt that we're carrying with the value of the assets. So sometimes you'll see, groups taking advantage of very high leverage, high debt ratio mortgages. And that is a good way to buy a lot of real estate maybe quickly, but it doesn't leave a lot of room for error or adjustments or things happening in the marketplace. So that's kind of something we've been talking a lot about is how can you invest passively and not lose your security, specifically with obviously real estate investing. If you're going to buy Bitcoin or something else, there's probably not going to be that level of security, but that's what makes real estate great is the actual real estate. So, and this is really important. If you haven't been following kind of in the last couple of years, what we're not afraid to talk about here is kind of what we can learn from what has gone wrong in the marketplace. And I think it's important to discuss because in the last few years, there have been a lot of promissory note mishaps happening. And if you're not aware of it, you can just go and Google some of these groups. But what became trendy a few years ago was using other people's money to buy real estate. And these were all secured via promissory notes. And so it really got us thinking and talking as a group, like, why were so many people doing this? And it was hundreds of millions of dollars that we're talking about in the last couple of years that have been lost to these high interest rate monthly payment promissory notes. And you know the saying, like when it sounds too good to be true, it probably is. That's very much what, unfortunately, a lot of these people got kind of wrapped up in. And, high interest payments, monthly payments, that sounds amazing. And it's great when it works, but it leaves very little room for anything to go wrong, for a change in rental market, for a change in costs, for delays in projects, all of the things that can go wrong. And a lot of those groups were using the funds for, large scale renovations or infill developments or something like that. And so these were projects that have no income and no money, and they're offering you monthly payments. So we have to think about that. Where are the returns coming from? And is that logical? Does that make sense? And so things can only, carry on for so long if things don't go right. So why were they giving up the edge? Why were they giving up the security? And that was why they were looking for monthly payments and they liked the high returns. However, the last point here, which is where I think not enough responsibility is being placed on the issuers or the people out there raising capital, is the eligible versus accredited definition. And what those terms mean is, it's honestly, to put it very bluntly, I think Rodney came up with this. You read it and it is a definition based on your income, on your net worth, how many assets you hold, and it really determines, or the government has determined based on your financial picture, what is a relative amount of money for you to invest based on honestly how much you could lose and probably recover. So, but people who are not necessarily uh, taking this seriously aren't even mentioning this. So they're not even asking. So if you're looking at any passive investment with us or anyone else, you should absolutely be getting asked this question. And that's why I'm highlighting it here. We will definitely ask it. But what I want you to know is if you're out there looking at offerings, this is a great way to put a little red flag up. If no one is asking you if you're eligible or accredited, then that's a red flag, because what these definitions determine is really what's suitable for you to invest. And I've heard many, unfortunately, very sad stories in the last couple of years where students retired folks, people who, put literally all their eggs in one basket. And we talk a lot about diversification here, and they put a lot of their, all their eggs in one basket at a time in their life where they shouldn't be. So, if someone would have been asking those questions, I do think their outcome might have been differently. They might have still invested, but they might not have invested as much, which is really the point of it. So if no one's asking you this and you're out there in the marketplace, like make a note of that they maybe are not, worried about securities laws, securities compliance, and are not necessarily educated in the way that they should be. So obviously, I kind of maybe have beaten this with a dead horse or with a, you know, um, uh, broom to this point, but don't give up your security. You need it. It's only, it's the only thing you can fall back on. That being said, there are risks. Things go wrong. No one has a crystal ball. We all wish we did, but keep your security. So whether you're private lending, doing joint ventures, or looking at private securities, what is your security? I want to highlight joint ventures briefly. I do think previous to this OPM trend we saw in the last 5 years, it was all about joint ventures. And everywhere I went, it was about matching people together. So if you want to get into a piece of real estate, maybe you have the capital or you have the experience, finding someone with the opposite needs or goals of you can make a really good partnership. And for, years, we still do joint ventures. They can work very well. It's very easy to lay out, rules and responsibilities and whose job is what. And each partner in traditional joint ventures have a piece of the pie as well. So they both have a piece of security, which to me seems fair. Whereas in all of these private lending situations, everyone, like one party has all the security and one party often has none. So I would love to see joint ventures come back in the ecosystem again as a way to get to work in active real estate. Obviously, WealthShare is a passive investment vehicle, but we, really would love everyone to also have their own active real estate too. I know that's getting harder and harder here in this landscape, but um, which could point to more and more joint ventures happening. Okay, so and if there's questions, please let me know. It's no problem to stop. So I want to talk about how to analyze passive investments. And then again, this is just a highlight. We do have a full document that I've written, a passive investment guide that goes into this even into more detail. But these are the main things that I think you should be asking us or anyone else if you are looking at passive opportunities out in the marketplace. So number one is the security. So I already talked a lot about that. Number two is the team, not just the team like you just saw. You just saw me, Rodney, and Monique. And yes, we are the co-founders and we are the ones doing a lot of the operations every single day. But also, who is responsible for helping those operators make decisions, if anyone else? Is there another board? Is there a board of trustees? And if so, who are they and what do they bring to the table? So we, as co-founders, are also trustees, but there's also 3 other trustees. So there's 6 trustees. So every time we do an acquisition or there's a big decision to make, or we have redemptions, or we're going to do a refinance, or there's anything that's really going to steer, this ship in a direction that is a critical point, the trustees will make that decision as a group. So it's really important to look at who are these team members and what do each of them bring to the table. So we have a lawyer as one of our trustees. We have a highly successful startup company expert, Sean Wilson, here from Calgary. He's bought and sold many companies here in Calgary and brings a super amount of experience when it comes to building companies from scratch. And then we have someone in the construction space that knows real estate, that knows buildings and building envelopes, and has a lot of the expertise that maybe we don't have. So check out the team. Do you believe in them? Does it make sense? And is it balanced in terms of who's actually making decisions? There are some groups out there where there is one trustee and one operator. So all of the decisions are falling on one person's head, and that could be a risk. Number 3 is structure. So what does the structure have to do with the passive investment world? If we're talking about private lending, the best structure you could have is ideally like a mortgage, just like a bank. If you know, think like the bank. How and what does the bank want to see if they're going to lend you money? So you want to have proper agreements in place. If you are doing the private lending space. If you are doing a joint venture, for example, there is a joint venture document you should have that outlines everything and usually either creates a new corporate structure or brings two of them together. And really, the point of that is to be making sure you're getting the proper advice if you're going to be creating those entities or investing into these entities. So, getting good legal advice on anything you do, especially something when you're like building something from scratch, always a good idea. Structure from kind of the passive REIT world is, you know, pretty similar out there, but it's also kind of complex. So a private REIT is really just a corporate vehicle that allows pooling of money in a single direction and with a common strategy. So there's all kinds of REITs out there. REIT is a real estate investment trust, and it just allows that pooling of capital towards a common goal. Our structure, our REIT also has what's called an offering memorandum. And remember how I mentioned about eligible investors and accredited investors? If we did not have an offering memorandum, then we would not be legally allowed to accept investment from eligible investors. And this right here is the biggest like asterisk, I think, of where folks sort of went wrong in the last few years out in the marketplace is we had eligible investors making investments that really should have only been done by accredited level investors. But because, the maybe sophistication wasn't there, the corporate structure wasn't there, then the oversight wasn't there, and the corporate kind of governance was not there. So understanding what kind of structure you're investing in is really important. And then also, how does the structure tie into the security? So how do those two things work together? For us, WealthShare Alberta LP is our kind of master limited partnership under the REIT, and that's our master LP, and everything kind of flows down below it. So all of that is outlined in our offering memorandum. If you want to see the very cool corporate chart, you can do that anytime. Number 4 here is a good one too, in terms of exit plan and timelines. And with this asking, what are the risks for you as the investor? So what kind of exit plans? If you're making a passive investment, this is an important thing for you to ask yourself. What kind of timelines am I looking for? Am I, wanting to place these funds for the next 20 years, or do I need this money back in 12 months? Those are two very different types of investments that you might want to consider based on your timeline. But then also understanding that things sometimes get delayed. What happens if it's delayed? What happens then? So, talking to whoever you're working with about these things is really important. Usually most REITs like us do have what's called a redemption process. Now, there's two often types of funds out there that are doing similar things, and some of them focus in the buy and hold space like us, and some of them focus in the development space. And those two even types of strategies will have very different exit or timelines. So obviously, if you're investing into a development, you're not exiting until the development is complete, likely. So that's a very different timeline. And often those have a fixed investment timeline. It could be 5 years or 7 years or longer, depending what it is. So just making sure that timeline aligns with what you're looking for. For the more open-ended REITs like ours, they will have their redemption process, and they may vary based on the amount of notice you need to give if you want to exit. There often is redemption fees inside of usually under 5 years. So if you're investing with a kind of REIT that focuses on buy and hold, they're going to get your money to work for you. They're not anticipating you to turn it around and come back 12 months later. But that being said, life happens. Things do happen, and you need to understand what the redemption options are should something arise for you. So at WealthShare, our redemption process is outlined in our documents. We do have a redemption fee inside of the first 4 years. and then no fee after that. So it's kind of a sliding scale, which is very common out in the marketplace. And you provide us a redemption notice of 60 days as well. So those are things to consider or look at. And then the last one here is actually, I have one more before I go to questions. And it kind of ties into security and structure too. I've seen a couple examples in the past year or two of people who have asked me to look into something and they made a passive investments in what they thought was a piece of property. So they thought they had security. Making sure that your documents line up with the piece of land and the company that says that they own that land, right? So it's very easy, especially here in Alberta. You can pull title on any property for $10 here. So I can pull anyone's title to make sure that they actually own what they say they own. And I know you can do that in other provinces too. You might need someone to help you do it, and potentially Ontario, but I know here in Alberta it's very easy. $10, you can look up who owns anything. So just checking, especially if you're doing like a private mortgage or something like that. Obviously, in that case, you're likely to have a lawyer registering it on title. But if you're doing these kind of smaller, like peer-to-peer deals, yeah. So, and you can always check these things, right? And if the person you're working with doesn't want you to check those things or just asking questions doesn't feel right, the gut check is a big, big one. Something doesn't feel right, it probably is. If it sounds just so good to be true, think about that and think about where the returns are coming from. I think that's the biggest thing that surprised me in the last few years is, there were so many groups raising money for these developments that have no income coming in and are offering such high monthly cash flow. So you're basically, using another investor's money to provide cash flow for you. That's really the only way to do it. So think about it, rationally, and then also just diversify. It's okay to take some risk. It's okay to have some higher risk stuff over here and different strategies, but have slivers of different things to really be diversified. Just like in the active investment space, no different, right? If you have a portfolio of real estate, you don't just want to have 5 condos in one condo building. Ideally, you want to have 5 properties in 5 different areas and even maybe different markets. So same thing on the passive side, being diversified is really, really important. So this is what our offer is. So, but this is more of a snapshot of some things that you should be looking at in terms of how to compare different offerings. And I might also pull up the guide here in a second if you'd like to see it, but if not, we'll send it out too. But so just as a kind of recap, when you're looking at opportunities, if the accredited and eligible questions do not come up, then that means that there is likely not the kind of level of oversight that you want to see from an independent third party. So I would just ask more questions if that's the case. Maybe the offering's only open to accredited investors only, and there are plenty of opportunities where that's totally fine and that's acceptable. But it's just something to kind of notice. The second point is, what type of money do you want to invest? So are you investing your registered funds? Are you investing cash? And the big thing here, I'm not sure if you're aware, but when a REIT especially first starts, and there's a lot of REITs coming up right now, if you weren't in our world 3 years ago, we had our road to 150, and everyone that was on this team remembers that time very well. Because to be a CRA compliant REIT or fund in Canada by March 31st of the calendar year of your first year, you have to have 150 investors. And if you do not have 150 investors, you are actually not registered account compliant. So if you would have taken in money, say the year before, and this date hits and you do not have your 150, you could potentially trigger a tax event for all of your investors who invested the year before. And so, we made a really awesome kind of program out of this. We had 150 people get behind us inside of a few months, and it was a really fun time. It was a lot of work in a very short period of time. But now what we are seeing too is there's just a lot of REITs popping up, and I know how hard this is. And so it's just something to keep your eye on. If you're investing in a brand new REIT that's only a couple months, in, just know that is something to be mindful of, is they do need to have the 150 by March 31st of the calendar year. And where was I? I was talking about the registered account. So yeah, so that's something really interesting. I see the people out there on their kind of road to 150, and that's why there's this sort of push to get people going. And that's the threshold that CRA has set, and that's just kind of the way it is. Now, minimum investment, there is out in the world right now in terms of passive investing. I mean, our minimum is $5,000, but you can invest in real estate with as little as $1 now. In recent years, the compliance has changed in Canada, and they even now allow crowdfunding into real estate. So there's an app called Addy Invest, if you're not familiar with them. They are a crowdfunding platform into real estate. So there's no budget that you can't apply to this space now, which is kind of cool. And each of these little opportunities also has their own sort of network with it and community that they're building. So what I love to see about all of this is just this push to sort of accessibility out in the marketplace. So there's more options than just handing your money over to your, financial advisor and coming back 20 years later and going, how did I do, kind of thing, right? Which is what a lot of people do. They do not keep an eye on what's happening, especially with their registered funds. So lots of options out there now. And if you haven't checked out Addy, I would definitely check it out. There's all kinds of opportunities on there. So talking about returns and how do you compare different opportunities, and if you're a passive investor, what should you be looking for? So diversification is a big one, but what you have to think too is the higher the risk, the higher the projected return should be. So the lower the risk, the lower the return likely will be. So I can't tell you how many times people go, well, you're targeting 8 to 12%, and so is targeting, 24%. And so I'm going to go invest over there. And sure, absolutely should. But also understand that a few things, often the over 20% in particular returns, they should be over 20% because they are development opportunities. So you're investing in a development in a project, and those returns should be over 20% annualized. But something to bear in mind when it comes to returns as well is kind of, when do you as the investor see the return, and how does it start benefiting me? And that's different depending on the type of opportunity. So there's two types of funds out there that you'll usually run into in terms of how this will affect you. So someone like WealthShare, like us, or other funds that do annual financial audits or annual valuations, there's a huge benefit to you as the investor every single year. So long as they continue to perform, you will actually see net worth growth in your passive portfolio on an annual basis. And I know for sure that lenders love to see that. So if you're an active investor as well, and you're trying to get mortgages, or you want to buy your own multifamily real estate, or whatever you're trying to do, you're trying to get a business loan, your net worth growth is important. So again, it's all about diversification. So invest in those, development projects as well, but maybe put, a sliver in this and a sliver in this, and have some diversification in terms of, is this going to actually directly impact my net worth growth yearly, or is it not for like 5 or 10 years? Because until you exit that project on some of these ones that are just fixed until it's complete, you won't see a return sort of on paper to provide to your lender or your financial planner. And so, depending on what you're trying to do, that could be an important factor for you. And then also, we talked a little bit about this, but how are returns made? And in real estate, there's really only 4 ways to make returns in real estate. And you can only do so much with it. So if you're doing buy and hold real estate, to project, say, a 20% return with just buying real estate and holding it is really not feasible. It's not really possible. unless you're doing a big project or you're doing something to it to force the appreciation of the asset. So four return streams in Canada are passive appreciation. So just whatever the market does over time, it passively goes up like everything does. Most people think about cash flow, which is an important one. We want to make sure assets are cash flowing. And then also, which is maybe my favorite one, is and the most predictable one we can see over decades of time is debt paydown. And the debt paydown, the leveraging the bank's money to invest it into something like real estate, is really the reason real estate investing is so lucrative. Because it's really hard to accomplish that in other investment strategies to leverage the bank's money. So debt paydown, passive appreciation, if there's some sort of forced appreciation or you're doing something to improve a property, that works really well. And then cash flow. So those are the four things. So whatever opportunity you're looking at, it's understanding where those returns are made out of those four things. One really cool thing about multifamily real estate, I was at an event last night, we were talking about this, was perhaps my favorite part about multifamily real estate is your valuation or the value of your building has nothing to do with what so-and-so's building across the street is worth or may have just sold for. It's directly valued based on how well you operate it. Your net operating income combined with the cap rate at the time will give you a valuation on your property. And so the better you manage your expenses, you get those economies of scale, you're maximizing rents. All of those are really critical to creating value inside of your assets. And a really kind of fun multiplier effect I like to mention about multifamily real estate is, roughly speaking, when you look at how value is made in this space, every $50 or so equates to at least $20,000 of valuation to an appraisal. So every $50, every parking fee, pet fee, every, efficiency we can get really does matter. So really having our eyes on our management every single day is critical. So another thing to look into if you're investing in a fund is, or something is there a set number that they're trying to hit in terms of the raise? There's closed funds and open funds. We're an open fund, so it's not like, okay, we're going to close our doors once we hit this and now we're done. That's not what we're doing. We're an open fund. Most people are familiar with many other funds out there like Equiton, and they have their apartment fund. Very similar idea. It's an open fund. And then there's closed funds that have a target deadline for a specific reason, and then that will close. If you're investing in a closed fund, a good question to ask is, where are they in their raise? What if they don't hit the raise? Is there a deadline? And sometimes there'll be like marked deadlines of when they have to hit it by, and it should outline too, there might be another plan. If they don't hit a certain amount, they may have another lender lined up or some other opportunity. So just kind of good to understand where they're at in that pathway in terms of the raising capital side of things. And then just if there's a set number of units or a set amount of investment that they're looking for, where are they in that process? So again, if you want the guide, let me know. Maybe we'll just send it out for this anyway. But a few questions that I wanted to point out to kind of wrap up. And if there is anything, please let me know or put it in the chat. I'd love to know what your questions are. But a good one too is that I didn't mention earlier is who is the beneficial owners of the assets? So if we're talking about our security and our real estate and our hard assets that we can see, feel, and touch, who is actually the beneficial owner on paper? And it might not be always what you think. Second one, we talked about how much debt is on the portfolio. Risk mitigation is a good one too. How do you mitigate risk when you're evaluating opportunities, and see what answers might come up? We like to keep our loan to value relatively conservative. And yes, Noreen, a corporation can make the investment. Yes, you still have to do the eligibility process, but yes, you can. Good question. So debt to equity, and that directly ties into our risk. But what also is important for risk mitigation, I know Monique is not here this evening, but How do you feel that the group is analyzing opportunities? Are they very conservative, or are they taking a best case approach kind of thing? We've always been trying to thread the needle of being conservative. If we do better than being conservative, awesome, but let's be conservative. Let's use conservative numbers. And if we're happy when we're looking at the acquisition or something we want to move on, being conservative, even worst case scenario, can we live with the worst case scenario? That's really what we're trying to find out. And if we do best case scenario, awesome. So being conservative with rental rates, rental figures, economics, all of those things. And sometimes, when the market's really hot, I always say everyone's a genius. um, but what about when things aren't so hot, right? Because nothing lasts forever. Things shift and change and move all the time. And in Alberta, we have been through the ups and downs, and I feel more confident now than ever in terms of less kind of, up and down a little bit here in our province. But even just in a balanced, competitive, a fair market, you still want to be managing risk, and not everything is a good investment necessarily just because it's a good market. So what is the largest risk? I like this question. I do get asked this a decent amount. I got asked this last night. And honestly, I think the largest risk is something that we can't predict. It is some large scale event that would likely impact rental markets. So that wouldn't just be unique to us. For us, because we're not building or developing, I'm not so worried about, price of materials or trades or anything like that, because we don't have all of those variables. For us, our most important component, of course, is tenants and rental demand. And so that would be the largest risk if there's something that could impact the rental market substantially, and that would be something, global economics, Canadian economics that would happen, I believe. I think Alberta is sitting pretty well, even our country, facing upcoming recession talk potentially, or maybe there's a lot of people arguing we're already there. We're still sitting very well here in Alberta, and we have a lot to offer and a lot to come in our future. So I feel comfortable with that here, but I guess that would be our largest risk. The last question is a very good question, and something that I probably wouldn't have thought of either without going down this path. Because when you are in this space of this multifamily world, when you go to these lenders, they want a guarantor of this debt. Doesn't matter if it's an insured mortgage with CMHC, you still need a guarantor. And the entity which owns the asset is not enough. So how it works in this space is you need to provide a guarantee on the debt. And it has to be, you have to provide a minimum net worth of 25% of whatever the loan amount is. So if you want a $10 million mortgage, you need to prove at least $2.5 million of net worth. And then that individual has to be a guarantor on the debt. So for WealthShare, we have stood as guarantors on all three of the acquisitions so far. And the reason that is so important is, yes, we have invested a considerable amount of time, energy, resources into WealthShare, and that is all very true. But we have also signed all of the guarantors for all of the assets, even though we are not the beneficial owners. So we have everything on the line, and as it should be. We have skin in the game and a lot on the line. So we are here to do an excellent job. We babysit this thing inside out and backwards every single day. When we brought the property management in-house, it was the best thing we ever did, because every day we know how we're doing. And when you outsource property management, you get like a picture of what happened 60 days ago. And that just never felt right for us. And so we take that very seriously. But you might not know that to ask other groups, right? You can actually, outsource guarantors. You could pay a fee to a guarantor. So there is several different ways that, oh, and Monique's joining us, that you could find guarantors. But in this case, it is us. And I think that's really important and speaks to how much we believe in what we're doing here. So that's the guide. I feel like I went on longer than I was intending to. If did I miss anything, Michael or Rodney? If you have anything to join, I know Rodney's at hockey, and I don't know if Michael's listening in, but and also Maggie, if you have any questions or thoughts. No, you're good. Awesome.
Yeah, no, I would probably say just the one highlight that we always take away, especially with us, is just being able to tie that back to an asset. From the stories about the promissory notes, and And yeah, you can pretty much Google horror stories in Ontario over the last few years about that,
Yeah.
right? So just making sure that it's tied to something is really key for everybody for sure. And thank you everyone for attending as well. And
Noreen asked a good question here. What are all of our investments in Alberta? Yes. So we have three assets in Alberta. Now, the only other province we are considering, I'll just put this back up. I didn't mean to end that. The only province we are considering is Saskatchewan. And there's a very good reason why. It's not because we necessarily dislike the rest of the country, but we do dislike their landlord tenancy laws in specifically Ontario and British Columbia. So that is a major reason why we focus on Alberta. Obviously, it comes down to economics as well. We are sitting in a very good position here in Alberta, but as I said, how well we manage these properties directly will impact you and your return. So if I couldn't, get a bad tenant out or raise the rent or, really maximize what we can do with these properties, it would be very difficult to um, provide the returns that we are wanting to provide. So Saskatchewan has a similar um, set of policies though. So and there's a Uh, can you explain what needs to happen if I want to do a recurring monthly contribution? Carlos, unfortunately, it can't be set up automatically. Um, if you want to have if you want to have an investment today and then you want to do a future investment, you would need to sign a subscription agreement every time. Now, obviously, future investments get a lot easier. But what it comes down to is Ryan at Atlas One is our exempt market dealer, and his job is to process our investments for us. So he'd be the one to talk to. He'll also be the one ensuring that that is suitable for you, Carlos, that it makes sense for what you're trying to do, and what amount to kind of get to at some point would be a suitable amount for you. So I think I connected you with Ryan, but he'll be the guy to kind of help you out with that. And unfortunately, it can't be automatic for compliance reasons. So we need you to sign every time and say, yes, this is what I want. So, but it can be all done DocuSign and it's pretty easy that way. So you have your profile set up on Atlas One. And then from there, it's just doing a DocuSign. It's a good question. We do have our information up here as well, our email and website and Facebook. I know I talked a lot about the guide, so maybe we'll email that out for those that might be interested. But where we're looking next is we have a couple opportunities in Alberta we're looking at, and then there's also one in Saskatchewan too. So no, that's a good question, actually, Noreen. The question is the investment specific to a single property or to a pool? And it is a pooled investment. So the pros of that are your returns are not reliant just on one property doing well. It reduces the risk across the actual investment. So as we grow, your investment returns will also grow from that. So it will be a part of the entire portfolio's returns. That's a good question. If you are looking to use registered funds, we have three trust companies that you can use. And those are Olympia Trust, Odyssey Trust, and Western Pacific. If you want to proceed, Michael, why don't you put your email in the chat there? Michael will reach out to you, Noreen, and we have your info as well, but maybe Michael can shoot his email in there. Michael is our investor relations manager, and he's here to help you every step of the way. We'll also, so immediate next steps would be to, do I have it? Oh no, I don't have a slide for that. Would be to create your account with Atlas One. Michael, maybe put your link in there. So Michael's going to put a link for Atlas One, and all they're going to need is a name and email to set up a profile. Once you go on there, you'll be able to see everything you need to see about us. You'll be able to see our financials, our offering memorandum. You'll be able to see also all the other opportunities on Atlas One. So it's a cool place to go. And Atlas One will be your hub. It'll hold your investment, it'll hold your subscription agreement, and also it'll be a place where we upload things as time goes on. So We'd love to have you, Noreen. We do have currently, I'm not, if you're watching the recording in the future, this might not be available, but currently today at this moment, we do have a $100,000 incentive. So for investors who are investing $100,000 or more, they would receive a 10% bonus in their units. So we were excited to kind of come out this spring with some good news and good returns. And we want to get those kind of foundational people rewarded for being here with us, but also for jumping in with us right now. We can't grow without our investors. That's really what this is all about. And awesome, Noreen, that's great. So we'd love to have you. So that's what it's all about for us. We do a lot of these events and hope to see you at future ones as well. And make your Atlas One account. It's really easy. And then if you do want to submit an investment, it's like you can submit right on there. You do need to verify your identity. Show us who you are. You need to put your ID and mailing address and things like that in there. And then it'll also ask you about your suitability questions as well. So your accredited status or eligible status. So platform will walk you through all that. And then, but we also do have Michael here and then Ryan at Atlas One to kind of guide you too. And if you're watching the recording, please reach out to us anytime. We would love to connect with you one-on-one and learn more about your real estate investing goals.
Thanks for attending, everyone.
Thank you. Have a good evening.